Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to look at what I consider to be the 6 most expensive stocks in the Dow Jones Industrial Average. In subsequent videos, I will be covering each of the additional Dow Jones Industrial Average constituents. I am basing my contention that these are the 6 most expensive stocks in the Dow Jones based on their operating earnings PE ratio. As you can see here, the lowest PE ratio of this first 6 stocks is Exxon. But I also want you to take note of price to cash flow, because all these stocks pay a dividend and they're all reasonably high yielding dividend paying stocks with the exception of Visa. And I do want to point out, as I will here in a minute, that price to cash flow may be even more relevant to dividend payers than earnings. So I'm going to look at each of these stocks in alphabetical order, by the way, starting with the Boeing company. And I've got adjusted operating earnings up here. And just to clarify things a little bit, I want you to notice that this orange line plots earnings per share for Boeing. And the first thing you notice about Boeing is that from an earnings point of view, it's a reasonably cyclical company. Earnings rise and fall. Their dividend record has been quite good. As you can see by this white line here, which plots dividends, it's been steady. Even during periods where earnings fell, the dividend continued to increase. And then when I put monthly closing stock prices on the graph, I want you to notice that prices correlate very closely to the earnings, or the orange line on the graph. And more recently, Boeing has separated itself significantly, and I consider this to be significantly overvalued relative to earnings. When I look at operating cash flow, however, for Boeing, I see a slightly different picture, although similar to what we saw with earnings. From an operating cash flow point of view, Boeing looks more reasonably valued. However, the company's normal price to cash flow has only been about 10 over this long-term historical view. So in this case, it's the blue line, which is plotting a normal price to cash flow of 10.5, that I think really illustrates valuation. So on this basis, Boeing would also be moderately overvalued. And then if you look at it from a standpoint of EBITDA, earnings before interest, taxes, depreciation, and amortization, you will also see that the stock has got disconnected. However, I do want you to notice that the forecast for EBITDA is actually pretty high. Their normal price to EBITDA is about 10, and they're currently trading at a 14 price to EBITDA. Now, there's a couple other things I'd like to quickly point out about Boeing. Obviously, it's an aerospace and defense company. It is A-rated, however, it has 114% debt to capital. So that's something that I think investors also should consider. As I change time frames here, the growth rate, because of the cyclicality of this company, is actually pretty high, but I do want you to notice that the company does routinely have weaker earnings periods and then followed by usually very strong earnings. And I think we're entering one of these strong earnings periods coming up. So there we have Boeing. I do consider it significantly overvalued and one of the more overvalued stocks in the Dow Jones. My next example is Caterpillar, and Caterpillar is interesting for a couple of reasons. If I look at the long-term history of Caterpillar, once again, you see a company with a lot of cyclicality, and it looks really significantly different than Boeing. However, you also see a consistent dividend record. And if I look at the performance results here, their dividends growth has averaged about 10%, but last year only grew by 2%. And the dividend growth can be higher during periods when earnings growth really accelerated. Now, Caterpillar is moving into an upcycle relative to forecasts, and that probably explains why the stock has been on such a tear here. And if I look at this from a standpoint of forecasting what the future might be, when I look at the forecasting calculator, the PE ratio is equal to the growth rate, forecast growth rate of 26.3%. But when I look at Caterpillar's normal price earnings multiple, you can see that the company has consistently been awarded somewhere between a 15 maybe and a 17 PE ratio. So I'll go ahead and pick a normal 17 PE ratio here. And the point is, if you bought Caterpillar today, longer term, you might make a little bit of money, but I do believe you face short-term risk with the stock. If it would go back to a more normal PE ratio, you could be looking at losses in the near term, although longer term Caterpillar may be fine. With my next example, I'm going to look at Chevron. Of course, we all know what's been happening with the energy sector, and you can see Chevron has had a significant earnings stress over the last 4 or 5 years as we've gone through this energy crisis, if you will. And I also want you to notice this white line, the area below this white line, represents the dividend payout ratio. Therefore, you will notice that in recent years, the company's payout ratio has been significantly higher than its earnings growth. Its payout ratio has been well over 100% and over 400% last year. So the company's not covering its dividend with earnings, even though the company has continued to maintain a moderate rate of dividend growth over the last few years while it's gone through this earnings stress. However, when you look at operating cash flow for this AA rated company with only 17% debt, you will see that the company is covering its dividend with its operating cash flows. However, once again, the blue line here becomes the better valuation reference, which is a normal price to cash flow of 7.8. And these numbers usually are, I always think these numbers are range. This would be 7 to 8% perhaps, or 6.5 to 8.5%, something like that. So at this level, Chevron would look moderately overvalued, but the real key is whether or not these operating cash flows are going to increase as the analysts are forecasting. My next Dow constituent is McDonald's Corporation, and when you take price off of here, I want you to see that McDonald's does have a much more consistent earnings growth rate or operating history than the other constituents I've just shown, although they did have several years of weakness here, and they are forecast to begin growing again double digits for at least the next couple of years or so. So if you look at what they expect for calendar year 2017, which ends in about a month, they're looking for a 14% growth rate, and we had a 15% growth rate last year, but then they're looking for earnings to slow down. But when I put price on this graph and extend this out a little further, you'll see that McDonald's stock price has generally tracked its earnings, and during periods of overvaluation or times when the stock performs poorly relative to the near-term future, you see these periods of weakness. And right now, this is one of the highest valuations that McDonald's has traded at. Now, you can also see by this graph that the market has been applying a slightly higher normal PE ratio, but even on that basis, McDonald's looks significantly overvalued. Their dividend record, however, has been exemplary. They've continued to increase their dividend. And I look at it from an operating cash flow point of view, their dividend is extremely well covered. And in this case, I'm also going to look at McDonald's free cash flow and point out that the dividend is also very well covered relative to free cash flow. In other words, the company is generating more free cash flow than the dividend. But I do want to point out that the company does have a lot of debt and is only BBB plus rated, which is investment grade. But I consider McDonald's extremely overvalued at current levels. And the point being is that just by looking at this graph, it ought to become pretty obvious that there's not really a lot of room to make any money over the next 3 to 5 years in McDonald's simply because of this high valuation. The company's earnings growth rate, even if you look at it positively, which a long-term forecast is 9.7%, if you look at normal valuations for McDonald's, you'd be looking at actually very low and even possibly going into negative rates of return over the next 3 to 5 years, especially over the next year or two. That's where I think the biggest risk is. High valuation is not a good time to be purchasing a stock. My next constituent is Visa, and probably the best of the group here from a standpoint of earnings growth. You can see their operating earnings growth record has been really exceptional, and the company's stock price has tracked that earnings growth. But notice what's happening to the PE ratios here in more recent years. The normal PE ratio has gotten very high, and even on that basis, Visa is moderately overvalued. So I like Visa. I'm actually, for disclosure, long Visa, and I think long-term Visa will make money for investors, so I'm not currently selling my Visa. Forecast for long-term are for it to grow by 17% a year. I think that's very realistic. But I do want to go to the normal PE ratio here and look at how the market has typically capitalized this company. So it has been a mid-20s PE, but I'm going to use a 25 PE ratio here as a kind of a median or mean PE ratio. And I want you to notice that at these rates, the rates of return for Visa are not really that enticing, even if the company trades at a 25 PE. This simply means there's no forecast for dividends here. So I do expect Visa to continue to grow their dividend going forward. Finally, my last example is Exxon, and Exxon looks very similar to what we saw with Chevron. You have almost exactly the same economic history here, the same cyclicality. Earnings have fallen. Their earnings are covering the dividend a little better than what we saw with Exxon. They're AA plus rated, 10% debt, And once again, when you look at operating cash flow as far relative to them continuing to protect their dividend, because with a 3.8% yield, that's really one of the most attractive aspects. But the real key is, are these big multinational oil companies going to recover? And if they do, even at a normal 15 times operating cash flow, but I'll go to the normal operating cash flow number, which is around 9, the rates of return would not be that high from a capital appreciation point of view. But on the other hand, dividend coverage looks adequate. So these are the 6 what I consider to be most overvalued Dow stocks. However, one thing I think that might come out of this, with the exception of maybe 1 or 2 stocks out of this group of 6, these stocks are really not that overvalued relative to the future. But the point is, the rates of return going forward are going to certainly be impacted by the high valuations that these 6 Dow constituents have. This has been Chuck Harville saying thanks for watching. I hope you got something out of this.